good morning, good afternoon, and good evening to all the participants from various parts of the world. I, Dimpi Mawani, heartily welcomes you all for the sixth season of NRI Knowledge Sharing Initiative, which is NRI Financial Conclave 2022, organized by Ashutosh Financial Services Private Limited. Today's webinar is on the topic of NRI financial planning on taxation and regulation aspects. In this webinar, we will understand that how an NRI effectively plan taxation in India in an efficient manner and also the same for the financial regulations impacting a non-resident Indian. The first part of the presentation on taxation planning will be addressed by Mr. Taxation Kothari, who is a tax and financial consultant and MD and CEO of Ashutosh Financial Services Private Limited. Mr. Rajit Kothari, who is a chartered accountant and certified financial planner and executive director of Ashutosh Financial Services Private Limited, will be covering the second part, which is based on the regulations for NRIs. Before we move on for the core presentation, let's start with the introduction of company and today's first speaker, Mr. Taxation Kothari, and then we will start the core presentation. Kindly post your questions in the chat box and those questions will be answered by the speaker after the core presentation. Thank you.
Years back, late Mr. Dinesh Kothari started a firm in the name of Messrs. Kothari and Company to provide tax and allied laws advisory services. Later in the year 2001, the activities of the firm got expanded into a corporate entity in the form of Ashutosh Financial Services Private Limited. Over these years, the company has emerged as a prominent player in the field of finance and taxation. The company operates with a quality management system certification of ISO 9001:2015 and is now a complete financial services solutions enterprise. Ashutosh Financial Services Private Limited is presently serving in the fields of investment services, insurance services, NRI services, income tax and estate planning services. Is in the activity of connecting people with investment opportunities for Indian markets, mutual funds, for equity, debt, and hybrid funds, portfolio management services, for equity shares, alternative investment funds, for listed and unlisted equity shares of unlisted companies, advisory stock portfolios, for curated portfolios of equity shares, bonds, that is tax-free bonds, taxable bonds, and capital gain bonds, fixed deposits of top-rated corporates, precious metals through sovereign gold bonds, for investing in global markets through mutual funds, equity shares of foreign companies and ETFs, and precious metals through ETFs. Insurance services by the company is provided by Ashutosh Insurance Brokers LLP, which provides insurance solutions for life insurance for life risk coverage, health insurance, mediclaim and personal accidents, insurance of assets for all types of risks, insurance for liabilities, retirement and pension planning needs, and investment through insurance for guaranteed returns and ULIPs. NRI services is a one-stop solution for NRIs to address the needs of investment in mutual funds, PMS, AIFs, unlisted stocks, foreign equities, and advisory stock portfolios, insurance for life risk, health, assets and liabilities, retirement planning, and investment through life insurance, complete planning and compliance for Indian income tax, advisory under FEMA and RBI regulations, estate planning for Indian assets, and complete support for compliance related to foreign tax laws in respect of Indian incomes and assets. Income tax and estate planning services works as advisory and compliance for income tax, estate planning, endowments, and charity. Our company is a unique setup which is truly a one-stop solution for all the financial and taxation needs of the client. The company enjoys a state-of-the-art infrastructure facility having its office in the middle of Rajkot city spread across 4,000 square feet area consisting of separate setup for each division. The company has a fine mix of personnel from financial and legal background like chartered accountants, lawyers, certified financial planner, and management graduates to form a dedicated team of skilled and qualified staff. The team works under the dynamic leadership of Mr. Dakshesh Kothari, who is the MD and CEO, and Mr. Rajiv Kothari, who is the Executive Director of the company. All the divisions and departments manage their operations with high-tech versatile software, and the entire IT infrastructure is connected with integrated file server for seamless exchange of data with security and regular data backup facility. The company has a fully equipped conference room with projection and video conferencing facilities, which make dissemination of knowledge, information, and interaction convenient. The company has its offices at Ahmedabad and Mumbai to facilitate the client. The company website www.ashutoshfinserv.com and mobile application AshutoshFinserv gives an overview of the happenings in the world of finance and is also a useful client user interface. We operate multiple investment management softwares for managing our client investment, having interface with our website and mobile app. With the help of our website, reporting software, and app, our clients can carry out complete paperless investment transactions and can have access to their investment portfolios on real-time basis. We regularly update our clients with latest happenings from the world of finance and taxation through digital mode of interactions using YouTube videos, WhatsApp broadcasting, social media that is Facebook, Instagram, and LinkedIn. The company has been conducting presentation on analysis of the union budget since last 17 years, organizing series of presentations for non-resident Indians on aspects of taxations, regulations, and investment since last 5 years. And the company is also arranging presentations for various sectors of economy and society by covering topics of vital importance related to finance, taxation, and estate planning. The company serves to more than 3,500 satisfied clients spread across the world and is actively maintaining business relations with many clients and groups for more than 60 years. Ashutosh Financial Services Private Limited is growing as a complete financial solutions enterprise with its presence felt not only in India but also globally. Mr. Dakshesh Kothari is a tax and financial consultant and the managing director and CEO of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He specializes in the fields of income tax, FEMA, trust laws, estate planning, and foreign tax compliances. On the financial front, he specializes in investment services and insurance services. He advises companies, trusts, high net worth individuals, and non-resident Indians across the globe on financial and tax and allied laws related matters. He is a trustee of various charitable trusts. He has been involved with a number of social service projects of Rotary Club and is a Paul Harris Fellow of Rotary International. He has been presenting analysis on the union budget since last 16 years. He has been delivering series of presentations on taxation, regulation, and investment aspects for non-resident Indians since last 4 years. He has also been addressing doctors, businessmen, industrialists, taxation consultants, chartered accountants, company secretary, NRI and postgraduate students of diverse branches on subjects relating to finance, taxation, and estate planning to make our society financially literate. His articles on financial subjects are regularly published in renowned newspapers like the Economic Times, Mint, etc., and also in magazines like the Lal Script. His interview was aired on ET Now as a mutual fund industry expert in the program named Swatantra, which is one of the most acclaimed investor education initiative of our country. He has also addressed a program dedicated to NRI on a leading Gujarati TV channel in Ahmedabad. He is a 360-degree versatile personality in the fields of taxation and finance, which makes him a unique and a truly a one-stop solution provider for a wide range of financial and tax-related matters.
All of you to the 6th season of NRI Financial Conclave 2022. We have been conducting this kind of events for NRIs, as you all know, since last 5 years. And this is the 6th season, which is in the year 2022. Despite COVID, we had continued our presentations in the Zoom form in those COVID years also. All these presentations are right now available on the YouTube as a matter of reference and record. The presentation today, which is NRI financial planning, taxation and regulation aspects. I will be covering from my side the taxation aspects, where I would be touching on to the core issues from the taxation perspective. So these are the core issues which we see while, or we feel that these are the issues which we need to touch up when we are into contact with the non-resident Indians. The first and the foremost issue which comes up in the minds of the non-resident Indians is that, well, I am a non-resident Indian and I am having my incomes in India as well as outside of India. How will I be taxed? So this is the first and the foremost question which comes up in the minds of everybody. Here we need to understand two simple rules and two simple principles which are true for all the taxation which is prevalent, or all the laws which are prevalent across the world. The first rule or the first principle is the residence rule. So when somebody is a non-resident, so he is a resident outside of India, there he is a tax resident and he is supposed to pay taxes on his global income. That is the income derived in that particular country and that also that derived in India. So that non-resident Indian is supposed to pay taxes on the incomes derived from his own country and the Indian income. Under the source rule, the country from which the incomes are sourced, that country will levy taxation on that particular income. So in this case, if incomes are sourced from India, India will also levy tax on the incomes which are sourced from India. Now, when it comes to India, there are different statuses, not just resident and non-resident, but there are three different types of statuses which are prevalent in India. There, the first status is resident and ordinarily resident in India, resident but not ordinarily resident, and the third is non-resident in India. So when somebody is a non-resident in India, and in most of the cases, people who are residing outside of India, they are non-residents. So there, under the source rule, only the Indian income which has been sourced from India is taxable in India. The foreign incomes are not taxable in India, nor the incomes of a business which is controlled from India are taxable in India. Now, India provides two types of resident-related statuses. The first is resident and ordinarily resident, as I said. People like me who are very much in India all the time. So they are taxed in respect of their global incomes. So where you are taxable in global income, you are a tax resident of that particular jurisdiction. Where the Indian income, the foreign income, and the income from the business controlled from India are all taxable. But there is a status under the Indian income tax law, which is a blend of resident and ordinarily status and non-resident status, which is a very beneficial status, wherein even if a non-resident comes to India and settles in India for at least a couple of years, he can enjoy that kind of a status depending upon his stay in India in the last 10 years. And that status is resident but not ordinarily resident. Till the time that non-resident is enjoying that status, his Indian income is taxable in India, and the foreign income is still, despite he being relocated to India for those period of 1 or 2 years, depending upon his stay, that foreign income would not be taxable in India. Now, the question arises that what is Indian income and what is foreign income? The income which is received, accrued, or arised from India is Indian income, and foreign income is the income which has not been received, nor accrues, nor arises in India. So, coming back to all this discussion and the original thing which I was discussing, that a global income of a tax resident is taxed in the country of his residence. So there what would happen is that his source-based taxation would happen in the country where the income has been sourced. In case of non-resident Indians, India would tax the Indian income. And in case of where he is a resident, his global income would be subjected to taxation. So when his global income is subjected to taxation, then what would happen is that the Indian income would be doubly taxed. India is already taxed, and at the same time that foreign jurisdiction would also tax it. So there one would feel that, oh, that my income is doubly taxed. But there comes the relief from double taxation avoidance agreements. India has double taxation avoidance agreements with at least 94 jurisdictions in the world. And under that, income which has been taxed in one jurisdiction under the source rule would not be liable to be doubly taxed, and relief, appropriate relief, would be granted to the non-resident who is being taxed in his country of origin or the country where his global income are supposed to be taxed. So this is something when it comes to the double taxation of income and the taxability of income in the hands of non-resident Indians. Now, one would feel, and this is something which we encounter in a lot of discussions with non-residents, is that are there any concessional rates of taxation available for non-resident Indians, or any benefits which are available to non-resident Indians in the double taxation avoidance treaties and also into the Indian taxation law? The answer would be yes. There are several reliefs or concessional rates of tax which are available. The principle insofar as double taxation avoidance agreement is that anybody who is a non-resident can choose the beneficial provisions either of the double taxation avoidance agreements, which we abbreviate as DTAA, or the local law, which is the Indian Income Tax Act. Whatever are the beneficial provisions, the non-resident can avail each one of them on a pick and choose basis. So now when we look at the rates of tax of certain incomes in India, where the source-based taxation is going to happen in respect of non-residents, in case of dividends, the taxation is at the rate of 20% plus surcharge, and interest income is at slab rates, which is the progressive slab rates. But India, as I said, has signed DTAAs with several jurisdictions, and there are concessional rates of tax which are applicable on these incomes, and they have been illustrated in respect of different countries, where one would see that these rates are quite concessional, and somebody who is a non-resident can definitely take up those rates and choose to be taxed on those concessional rates. Further, there are certain articles under the DTAA which provide relief from taxation to non-resident Indians. So, for instance, in respect of DTAA with so many of the jurisdictions, including UAE in several African and Middle East countries, the article says that capital gains would be charged only in respect of immovable assets and certain movable assets which are specifically laid down. But they do not include certain other assets. And in the instant case, the relief which is available is that if there is any sale of mutual funds of held by the tax residents of all these jurisdictions which I have stated, then those incomes in respect of capital gains of these jurisdictions can be claimed as completely exempt. So these are certain beneficial provisions which are available to non-resident Indians under the DTAA, which all non-resident Indians who are tax residents of these jurisdictions can take benefit of. Then, when it comes to the rates of tax, in India, there is a levy of surcharge and educational cess when the taxes are calculated. So, when it comes to a rate which has been selected or which has been chosen by a non-resident Indian under the DTAA, that is the rate which is the final rate which the non-resident Indian has to pay. The non-resident Indian is not supposed to pay any surcharge or any other kind of cess, and that is the only rate which he is supposed to pay, which has been prescribed under the DTAA. Then, when it comes to the special tax regime which is being offered by the Indian Income Tax Act, there are provisions under Chapter 12, Capital A, which states that where there are any specified assets, and by specified assets, what I mean is shares of Indian companies, debentures and deposits in public limited companies, and government securities. When these kinds of assets are held, then these assets can be taxed at a concessional rate if they are purchased from convertible foreign exchange. And these rates are, in case of investment income, it is 20%. In case of long-term capital gains, it is at a concessional rate of 10%. Moreover, when there is an incidence of capital gain on the transfer of these specified assets, then if the consideration on the sale of this specified asset, if the consideration of this specified asset is invested in a new specified asset, and if the new specified asset is held for the period of 3 years, then the entire long-term capital gain on this specified asset can be claimed as completely exempt. So over and above, whatever reliefs are available under the DTAAs each of the jurisdictions, these are the reliefs which are available to non-residents under the Indian Income Tax Act. Now, there are provisions of TDS which are special to non-resident Indians, and also the provisions of advance tax, which when we talk with the non-resident Indians, this is an issue which requires a good deal of discussion also. Normally, it is believed that the rates of TDS are akin for residents and non-residents, and that is a common mistake which is made at the time when tax deduction at source is being done. But the fact is that there are separate provisions for non-resident Indians when it comes to the TDS, and there is a specific provision under section 195 which states as to when the recipient of any income is a non-resident, all the provisions of the TDS which has been laid down and the rates prescribed under section 195 and the rule pursuant thereon shall be applicable. There is no TDS in respect of incomes which are not chargeable to tax. But as I said, and I repeat, that all the provisions of TDS in respect of non-resident Indians are governed by section 195. When this section 195 operates and there is a tax liability or tax deduction of source which is supposed to be done in respect of non-resident Indians, then there are reliefs which are available whereby either the payer who is supposed to pay to the non-resident Indian or the payee who is the recipient can apply under the different provisions of law to reduce the incidence of payment of, or rather deduction of, TDS. And the most common is under section 197, wherein a non-resident Indian can make an application to the assessing officer stating that my liability in respect of a particular transaction for taxes is not to the extent what has been laid down under section 195 as the rate of TDS, but it is much lesser. So I be issued a certificate which is for lower tax deduction or nil rate of tax deduction. Then the provisions of advance tax liabilities are applicable to non-resident Indians the way they are applicable to resident Indians also. So whenever the tax liability exceeds 10,000 rupees, and tax liability by which what I would mean is that total tax liability minus TDS or TCS which has already been done, and thereafter the amount which is supposed to be paid is exceeding rupees 10,000, then there is a tax liability even for non-resident Indians, and it has to be discharged in 4 installments in different percentages as it has been laid down in the slide. When it comes to the tax liability on advance tax on capital gains, which has arisen during the year, the liability in respect of capital gains has to be discharged in the immediate next installment of advance tax, because capital gain arises not in a linear manner and the SSC is not aware as to when that capital gain would arise. So the NRI is not under a default. The tax liability, if it is paid in the next installment, it is a proper discharge and no interest would be charged. But if in case, if appropriate amount of tax has not been paid under advance tax, the way I have shown in the earlier slide on the basis of the calculation, then there would be an implication of interest either for late payment, short payment, or non-payment of advance tax. There is a misconception that Senior citizens who are non-residents are exempted, but that exemption is only available to resident Indians, and the exemption for senior citizens from payment of advance tax is not available to non-resident Indians. Now, the transactions in respect of immovable property, there are so many issues, so many discussions which go on, wherein the non-resident Indian definitely likes to understand as to what is my liability in respect of TDS and taxation when it is a transaction in respect of a sale of any immovable property. So the first and foremost thing that we need to understand is that how will taxation happen in respect of immovable assets, which includes agricultural land which is located within this specified area. When agricultural land is located within the specified area, there is no differentiation with any other immovable assets. But if it is located beyond the specified area, then that agricultural land is not considered as a capital asset and not liable to taxation in India. As it is not liable to taxation in India, it is not an income chargeable to tax, and hence the provisions for tax deduction at source would also not be applicable. Now, coming to what is the amount of tax or what is the rate of tax, if the immovable asset is held for the period of 2 years and beyond, it would qualify to be long-term capital gain, and the rate of long-term capital gain is a fixed rate of 20% after allowance of indexation on the cost price of the non-resident Indian. And the rate of TDS is also 20%. Now, in case of resident Indians, the rate is just 1% on all transactions of immovable assets. So this is a differentiation when it comes to taxation of non-resident Indians. If a immovable asset is held for a period which is less than 2 years, then it is taxed as a short-term capital gain, and it will be taxed at a slab rate. And the rate of TDS in this case would be 30% with surcharge and cess as it might be applicable. The levy of surcharge and cess on that rate of this 20%, 30%, whatever has been either the TDS or the rate of tax payable would be that to the extent of income of 50 lakhs, there is no surcharge. 50 lakhs to 1 crore, 1 crore to 2 crore, 2 crore to 5 crore. If the income falls in these brackets, or the consideration in this case falls in these brackets, this is the levy of surcharge which progressively increases. And if the income increases or is beyond 5 crores, there is a maximum rate of surcharge. On this amount of tax and surcharge, there is a liability of a cess at the rate of 4%. When it comes to the incomes from the transfer of certain capital assets or dividends, the maximum rate of surcharge is 15%. But when we are talking in respect of immovable assets, the surcharge is at a progressive rate. So whatever is the amount of sale consideration in respect of the immovable property, the levy of surcharge and cess would fall accordingly. So if the immovable asset is sold for a consideration of 40 lakhs, it is below 50 lakhs, hence there is no levy of surcharge, only cess would be levied. But if it is 60 lakhs, then surcharge and cess both would be levied. So whatever is the rate bracket which it fits into, that is the rate at which surcharge and cess is supposed to be paid. Then the question which comes up in discussion is that what is this sale what is the amount on which TDS is supposed to be made. In our view, the TDS is supposed to be made on the entire sale consideration of the immovable property, not just on the amount of capital gains. If the non-resident Indian feels that I would be taxed or large amounts of tax would go into TDS, which is not required as such because that is not my tax liability, an amount much beyond it is being deducted, then he should approach for a certificate for lower tax deduction under section 197 and obtain a certificate whereby lower rate of TDS would be applicable, or the buyer would be in compliance of law if he has a certificate from the assessing officer where lower tax deduction of tax has been approved by the assessing officer under section 197. So this is all from my side in respect of the core issues on the taxation part. And now I'm very happy to hand over to my son and CA Rajit Kothari, who is the director of the company, to take it forward. And this is for the first time that the presentation which I am making is now being shared by somebody else also from my team. Thank you. Thank you, everybody.
Thank you, Mr. Dakshish Kothari, for giving us the clear understanding on such a difficult topic in simple manner. Now let's move on to the second part of the presentation. And before that, I would like to start with the introductory video of the speaker for the second part of the presentation, CA Rajit Kothari.
Mr. Rajit Kothari is the Executive Director of Ashutosh Financial Services Private Limited, which is an ISO 9001:2015 certified company with prominent presence in the field of financial services. He is a chartered accountant and a certified financial planner by qualification. Further, he has graduated in the field of commerce with specialization in banking, financial services, and insurance sector from Ahmedabad University, and has also pursued post-graduation in the field of law. He started his journey with Ashutosh Financial Services Private Limited, where he played an instrumental role in functioning of several business development activities of the company. He also played a vital responsibility in the development of exotic product offerings for the company in the alternate investment arena, such as foreign equity and unlisted stocks. Moreover, he was critical in the preparation of extensive knowledge database on different topics concerning taxation and finance for the company. Thereafter, he worked with Messrs. Deloitte Haskins and Sells LLP, one of the leading global consulting firms at Mumbai, focusing on tax and regulatory compliance for high net worth resident and non-resident individuals. He is an expressive public speaker and addresses professional forums on diverse topics related to finance, as well as other topics of national importance. He has participated in international exchange program as a student and has also attended management development programs across top business schools in India. As a young and dynamic director with a multi-skilled personality, he presently concentrates on exploring innovative business opportunities through geographical expansion, digital proliferation, and concentric diversification of the company. Mr. Rajit Kothari is the Executive Director of Ashutosh Financial.
Hello, everyone. It is really nice to see all of you from different parts of the world enthusiastically participating in this knowledge sharing exercise of ours. Moving to the second part, which is core issues from regulation perspective. The first and foremost, which comes to the bank accounts held by non-resident Indians. Now, we know that most of us know the different kinds of bank accounts that non-resident Indians hold, which is NRO, NRI account, and the features of most of them. So in this, what we are trying to convey is we do not want to go into the nitty-gritty and the features of all the bank accounts, because that is something being non-residents or relatives of non-residents, we all are aware of. What we intend to share is one unique piece of advice which can be useful in dealing with these accounts. Beginning with NRO account, our advice is that there shouldn't be any substantial balances structurally which are parked in NRO bank account, for the reason that they are non-repatriable, meaning they cannot be directly repatriated or sent outside India without carrying a certain procedure. Further, the interest on that is taxable. So interimly, I mean, for some short period of time, there can be funds which are parked in NRO account for some purpose, but structurally for longer term, it does not make sense to park funds in NRO bank account because it is non-repatriable and the interest is taxable. As far as NRI bank account is concerned, which is a repatriable account, it is ideal that all the permissible investments, as in all investments like investments in mutual funds, shares, NPS, which can be directly made through the NRI account, should be done accordingly. Because in case of sale of those assets, the funds can be directly credited to the NRI account, which can be further repatriated outside India. And there is no requirement to go through the procedure of transfer, and many of the formalities can be saved. The same holds true while purchase of immovable property. In case the immovable property is purchased directly through the NRI bank account, then repatriation or sending funds outside India becomes quite simple and convenient for non-residents. Another strategy that we would like to share while dealing with NRI bank account is that there can be deposits which can be parked in the NRI bank account, which the interest on which, as we are aware, is tax-free, and borrowings can be made against these deposits, which can be invested into some kind of commercial activity, be it some business or some real estate venture or any kind of commercial activity on which the interest can be allowed as a deduction against the incomes. This has got dual advantage. One is that the interest on the deposit is tax-free. And secondly, the interest which is paid on the borrowings against these deposits is allowed as a deduction against the income. So this is a strategy by which many non-resident Indians can play. Moving to the FCNR account, which is a foreign currency denominated account, can be used whenever there is an unfavorable exchange rate fluctuation which is anticipated in the short term. So these deposits can be short term or long term, depending upon the requirements of the non-resident. And whenever any exchange rate fluctuation is anticipated, one can park the funds in this deposit and can also borrow against these deposits. Similar to the NRI account, deposits can be parked against the FCNR. Deposits can be parked in FCNR, and borrowings can be made against the same, which can also be invested in any kind of commercial activities, due to which there is a dual benefit. One is of the interest concession, the tax on the interest, and secondly, the interest which is on the borrowed funds can be availed as a deduction. RFC account is an account which can be used by returning NRI to avoid foreign currency fluctuation. And secondly, the interest on this account is also exempt when the individual is either a non-resident or resident but not ordinary resident. Last, resident savings bank account. It is advisable to discontinue this account because non-resident Indians are ideally not allowed to hold this account under FEMA, and it leads to a violation of FEMA. Now, many non-resident Indians that we come across have this common point that there's no problem and people are holding this account since ages. But in this era of digitalization, wherein information is so seamless and mapped through one unique identification of, say, Aadhaar or PAN, the day is not far where this violation will come in the eyes of the authorities, and there could be problems on holding this kinds of illegal accounts. Just some general pieces of advice. It is ideal to only maintain need-based accounts to avoid any kind of hassles of maintaining additional accounts, to save time as well as the cost of maintaining unnecessary accounts. Secondly, all the bank accounts should be updated with the latest information in terms of the email address or contact numbers, because whenever there is any kind of transaction which requires some authentication or updation, any kind of authentication, then OTPs can be received on that respective email address or contact numbers, and the transactions can happen seamlessly. Also, in cases of succession, if there are nominations which are effectively in place, then the process of succession becomes quite smooth. Another important issue that we always advise non-residents is to maintain books of accounts in India. Prima facie, let me clear that there is no legal requirement for non-residents not having business in India to maintain books of account, but it is advisory, or it is advisable, and it brings a lot of operational convenience to non-residents because of multiple reasons. The first reason is that there is an organized trail of all the financial transactions through which, if the books of accounts are properly maintained, meaning whenever later, for instance, let me give an instance. In future, in case if there is a sale of an asset and someone wants to trace the source of the funds, whether it was made through repatriable source, meaning through NRI account or through direct remittances from abroad, then if there are proper books of accounts, then the same can be traced very conveniently. It also helps in maintaining the real-time financial position of the individual, meaning the person can know where he's standing in terms of his incomes, assets, and the overall financial position, which can help him take effective decisions in future. There is a lot of convenience which books of accounts brings when the return filing is required, because there are so many incomes which have chances of being missed out in case proper accounts are not maintained. And also in cases where there is some kind of assessment, be it some scrutiny or whatever notice which is issued by the income tax department, and if there are proper books of accounts which are maintained with adequate record, and it is quite convenient to substantiate our claim and face the department. Then in case of some event of, say, death or incapacitation which can occur, in case of non-resident Indians who have got assets in multiple countries spread across the globe, it's quite easy and operationally convenient for them if there are proper books of accounts maintained, so that succession of those assets becomes quite smooth and convenient. Another important issue which we come across is regarding the transfer of funds, as to how can non-resident Indians transfer funds outside India which are held in India. Now, there is a regulation in FEMA provided by the RBI, which allows non-resident Indians to transfer up to $1 million per person per year from the NRO account to the NRI account or directly outside India. There are several conditions for this to happen. First is that the taxes should be paid on this, and there should be a certification backed by a chartered accountant stating that proper taxes have been paid. Further, it shouldn't be from any kind of borrowed sources whatsoever, or any kind of transfers from some other an NRO account of the same individual or another individual. And the remittances should be made through the same authorized dealer, meaning the same bank should be used for making all the remittances for one individual. Now, we often come across situations wherein $1 million is a small sum for some person, and that person is intending to transfer more than $1 million. Now, the Reserve Bank of India has given certain guidelines, certain scenarios in which this is possible. Say, for example, if there is some inheritance which is being received by a person who is outside India, or there is a non-resident Indian who has got some sale proceeds or some legacy which is being received, which is exceeding this, then an application will have to be made to the Reserve Bank stating this requirement of transferring more than 1 million US dollars. And if the Reserve Bank is satisfied, and if it is proved that hardship will be caused in case if the person will not be able to transfer that amount, then the Reserve Bank may permit such greater amount of transfer. Now let us look at what are the advantages of transferring NRO bank account balances into NRE account. Of course, we all know that the NRE account interest is tax-free, so that advantage is always there. Since it is tax-free, TDS would not be applicable on that interest income, which is another advantage. Now, the balances on NRE account are easily repatriable. So at any point of time, if the non-resident wants to transfer money from the NRE account to outside India, then it is possible at a click of the button, which brings a lot of convenience whenever funds are required outside India. Last, when it comes to exchange rate, in these times when the exchange rate is so volatile, everyone wants to take the best advantage of the exchange rate and does not want to compromise on the exchange rate because it can change the remittance to a great extent. So if the funds are lying in the NRE account in the repatriable mode, then at any point of time when the non-resident Indian feels that he or she intends to transfer funds, that can be done seamlessly. One point of clarification is that this relaxation given by the government is no obligation. It is because it has got good forex reserves and the government wants to let non-resident Indians have funds outside India. It has given this kind of a benefit. Otherwise, there is no obligation on their side. Now, when it comes to immovable properties, the regulation of FEMA says that if the immovable property was purchased through NRE bank account or directly funds remittances from abroad or FCNR accounts, then these repatriation can happen seamlessly without the funds going through this route of $1 million, provided the taxes have been paid and CA certification is available on this. However, in case of residential house property, this is only subject to 2 residential house properties. While in case of all other immovable properties, if the acquisition was through some repatriable source like NRE account or remittances from abroad, then it did not go in this 1 million route. It can go directly subject to payment of taxes. When it comes to current incomes, which are incomes like rent or interest or some business income, these are all current account transactions in which there is no specific approval which is required from the government or the RBI. And these current incomes can be directly repatriated once the taxes have been paid, provided without any limit. And this current incomes will not fall in that $1 million limit. They can be seamlessly remitted over and above this 1 million limit. One common question that we always come across is that, can non-resident Indians invest in real estate in India? I often wonder what is the reason for this, because there is no major restriction as far as non-residents to invest in real estate in India. But then I got to know that when it came to times of FERA, there were lots of restrictions long back, even before probably I was born. And for every real estate that a non-resident Indian wanted to purchase, there were a host of different approvals and restrictions which were in place. Now, gone are those days with FEMA, wherein non-resident Indians can purchase any number of real estate, residential house properties, commercial properties, or whatsoever. There is a restriction for them to purchase agriculture land or plantation, but they can inherit that. However, they cannot engage in real estate business. What means real estate business is buying and selling of land. Or they can also not invest in a venture which is into real estate business. Now, how to define a real estate business depends on the facts and circumstances of the case. Because on one side, non-resident Indians can invest in real estate, but they cannot engage in business. Now, if the arrangement of that activity is such which implies a business, meaning the acquisition and sale has happened in a short interval in greater volumes with some borrowing of funds, then that can amount to a real estate business, and that is something which non-resident Indians are ideally not allowed to do. At the same time, they can enter into construction business or development of some real estate business, and that is possible if the business is being designed and the principles of the business have been laid in that manner. With this, we come to the end of our session, and this is a general disclaimer that all the views are our personal views, and we do not intend to give any kind of investment advice. And wherever we have used some kind of data, we have tried to give the references. These are details of our further presentations, which is the virtual and the 3 physical presentations. And we would love to have all of you in these sessions as well. We thank you so much for sparing your valuable time on this weekend. And with these words, we throw open the house for questions.
Hello, we hope that you had enjoyed the session and several common queries that NRIs used to have in their minds would have been cleared now. Now let us take some questions that have been asked by the participants during the webinar. Participants can also raise their hand for interacting with the speaker and asking your queries. Our first question is, being a US tax resident, how important is to declare foreign incomes in US, and how can they declare their Indian incomes in US?
Yes, so as discussed in the webinar, it is very important to disclose incomes in the country of ultimate residence. So in the first place, the person will have to determine what is his ultimate country of residence, whether it is India or USA. Let's assume in his case, if it is India, then he has to disclose his global income in India, meaning the Indian income as well as the US income. And thereafter, he can claim credit of whatever taxes that have been paid in US under the double taxation avoidance agreement. So it is very important to disclose both the incomes, but in prima facie, the person will have to look what is the ultimate country of residence if he is becoming the tax resident of both the countries, India and US.
Thank you. The next question is, needs an advice for tax on dividend income of NRI from listed companies. Like, is it 20% or NRI can opt for slab rates?
Under Section 115A of the Income Tax Act, the rate of 20% on dividend income has been clearly defined. So in our view, there is no option for non-resident Indians to opt for the slab rates as far as dividend income is concerned. That is applicable for resident Indians. But for non-resident Indians, there is 20% flat rate plus surcharge if it is applicable.
Okay, thank you.
Hey Rajit, thanks
Hi,
for
Priya.
the informative session. I have one query. When we say when we are transferring funds from NRO to NRE, there are a few formalities needs to be done, CA certificate and everything, and the source of the income will be verified. So my question is, let's say I have a need of transferring a fund from NRO to NRE around October month. Now, let's say I'm transferring 7 lakhs. So how at that point of time, the income tax calculation will be made, during the assessment year?
As far as the transfer is concerned, there is no tax implication on that. because it is just one, your funds lending from your one account to another account. And there is no tax which will be collected at source as well, because you are a non-resident Indian. So there is no tax implications as such in India whenever you transfer your funds from NRO to NRE account. It is only to be ensured that there's on that amount which is to be transferred, appropriate taxes have been paid if it is arised out of some kind of income.
Yeah, so let's say I had a fixed deposit, and which is maturing, and now after the maturation, I'm transferring the principal and the interest to NRE, and then I'm repatriating. But then at that point in time, just the the verification is needed, right?
Correct. There is a certification which will have to be given by the chartered accountant, proving that the funds that appropriate taxes have been paid, and the funds can be transferred.
Okay, thank you.
Hello.
Yes, please.
Okay, I want to know if the NRI has a joint account in a resident with other family members, then what should he do? Like you said, they're not allowed to have resident accounts, right? The NRIs.
Correct. So
what happens when he has with parents a joint account?
So ideally, if it is a resident account, then the non-resident Indian should withdraw himself from that joint account, because under FEMA, non-resident Indians are debarred from holding any kind of resident Indian bank accounts.
But we cannot just let his name be there in the account?
When he's a joint holder in the account, meaning he is one of the account holders, and under FEMA, that is not allowed. Non-resident Indians cannot be either a joint holder or a sole holder to any of the Indian bank accounts.
Okay, so he should get it removed. Right.
Correct.
Okay, thank you.
Hello.
Yes, you are audible.
My name is Mahendra Gupta. I'm calling from Dubai. Can you hear me?
Yes, we can. Please go ahead.
Sir, I would like to just add to this question which the participant was asking you regarding transfer of funds from NRO to NRE. As per the RBI circular of 2015, now there is no need of any chart accountant certificate while transferring the funds. Simply what you need to do is you need to submit a declaration to the bank that these funds have been credited to my account out of my fixed deposit maturity, or out of my savings, or out of my dividends, for which the tax has already been paid. And then based on that declaration, the funds will automatically get transferred to your NRE account. And we have been doing it for last many years.
From what we have observed, this is a certification 15 CA-CB, which is required for any kind of transfers from NRO to NRE.
Now these forms are no more required as per the RBI circular of 2015, and they have designated 37 points in that circular, that if this money is for your savings and family maintenance, you are transferring these funds as an NRI from NRO to NRE, then there is no need of any form 15 CA-CB. This has been accepted by Axis Bank based on that circular.
Fine, we differ on that. Can we know the question?
No, my question was nothing. Just I wanted to add to this conversation what I was listening from the participant who is asking you this question. So since you told him to submit a certificate. So I thought, let me also add to your knowledge on this issue, because we have been doing it for many years.
Okay, fine. Thank you.
Next question. Next question.
Our next question is it a mandatory legal requirement to maintain books of accounts?
So as we discussed earlier, there is no mandatory legal requirement for non-resident Indians to maintain books of accounts in India. But the reason why we are advising clients and everyone to maintain books of accounts is because of their own operational convenience for multiple reasons that we discussed, so that they come to know about their financial position. So it is convenient in case of succession, in case of tax return filings, assessments, etc. Otherwise, there is no mandatory requirement to file the tax returns. Mandatory requirement to maintain books of accounts.
Okay, thank you. The next question is, can an NRI buy real estate in India, or are there any restrictions over that?
Any NRI can buy real estate in India. There are restrictions for non-resident Indians to buy agriculture lands, some plantation kind of activity. And similarly, they can also not engage in business of real estate. Otherwise, they can buy plots of lands or some other commercial property, and they can invest in real estate in India.
Thank you. One more question. If NRI sell property, is there any taxation?
Yes, there is taxation on that. And as we discussed, there is a rate of 20% on the capital gains if the gain is long-term, meaning the holding period has exceeded 2 years, plus surcharge if applicable. And in case if the gain is short-term, meaning the holding period is less than 2 years, then the gains are taxed at the slab rates of income.
Thank you. One last question, please.
Yeah, can you hear me now?
Yes, we can.
So my question is, my husband is German and I would like him to be my nominee for the NRO account. Is it possible for a non-Indian or a German person to be a nominee for an NRE account?
To be a nominee or a joint holder?
For both the nominee as well as for the joint. Is it possible that a German husband can be a part of it?
Okay, and is that person of Indian origin? I mean, in any way or not at all?
Not at all. He is not at all Indian. He is completely German.
As such, NRE or NRO account cannot be held by persons who are not of Indian origin, who do not have the OCI card. So that will not be possible, because ultimately if he becomes the nominee, then someday he steps in the shoes of the account holder, which is not feasible. So that will not be possible.
He can also not be nominee then, right?
Yeah, correct. He cannot be the nominee.
Okay,
And,
okay, thank you.
Is he married to somebody who is a person of Indian origin?
Yeah, he's married to me. So I'm an Indian passport holder.
Okay. And since how long?
We have been married since 4 months now.
4 months. Rajit, I think you can take it forward from this information.
Okay. And in that case, if the marriage is subsisted for this period, then
period of 2 years and beyond.
2 years, yeah.
Yeah.
Then it is possible to open a joint bank account. So after that period passes, then you can open a joint bank account with that person.
So after 2 years of marriage being subsisted, then the way you are a non-resident Indian, that person will also be considered as a person of Indian origin and can be a part of, or rather a joint holder or a nominee, whatever you desire in respect of the bank account.
Okay, okay. Thank you for the information. This is really helpful. Sir, I would also like to know that does India consider, I mean, this kind of 2 years, whatever you said, is it from the, so I have registered my marriage in Europe, but it's not yet registered in India. So date of Europe will be recognized or date of India will be recognized as considered as 2 years, starting from where?
The registration is not required in India. The marriage has happened in a country outside. So the marriage has to subsist. No, it's not necessary that marriage has to be registered in India and thereafter it has to subsist for 2 years.
Okay, okay, perfect. Thank you so much.
Pleasure.
Thank you, sir. We are having a last question in our chat box. That is, if the property is sold few days back in Rajkot and it was in a wife name and the fund received is in NRO account. So now, can they transfer that funds to relative or should they transfer to NRE and then transfer to them?
In case if they are intending to repatriate those funds outside India, meaning if they want to transfer those sale proceeds of the property outside India, then what they need to do is that they need to simply transfer it to the NRE account in the process that we outlined with the certification and the procedure. And then from NRE account, it can directly go outside India. There is no need to transfer it to some other person in between. It will unnecessarily complicate things.
Thank you. Thank you very much. We thank you all for your kind support and joining us for the webinar. The recording of this presentation will be available on our YouTube channel, AshutoshFinserv. We look forward to see you again in the next webinar on 3rd of December, Saturday, on the topic NRI Financial Planning on Investment Aspects. Thank you.
Thank you very much. Thank you.